Hey everyone, how are you? Chris Urso here with URS Capital Partners, or URS Capital. Wanted to take you guys through, we're a little behind, summer months, and it's been pretty busy in the office last few months, but wanted to get you guys through our Q2 update just to stay consistent. This is probably our fourth or fifth version we've done now. My goal really when starting this was to provide, true KPIs on our portfolio quarter over quarter. Just a lot of headlines out there about, new supply or rent softening or, concessions, etc. Just trying to give like real visibility into how our portfolio is performing, both for our existing investors and those of you that might be interested in investing with us in the future. So I'm going to go ahead and get started here. And if you ever have any questions, please don't hesitate to reach out to us at info@urscapitalpartners.com or rebecca@urscapitalpartners.com. So for those of you that are new with us, quick background. I'm not going to spend too much time on this, but ultimately we started the business back in 2009. Our first apartment purchase was a vacant 40-unit building in a pretty rough part of Cincinnati. And we've gone on from there to acquire 27 properties. We're on our fourth ground-up development, as you can see there, combined, over 5,000 units of multifamily. We've sold 23 of those deals, nearly 4,000 units since inception. Generated an average IRR of 32.9%, average equity multiple 2.07, with an average hold time of 39 months. The portfolio really spans kind of the southeast and Portland, Maine. Believe it or not, this property here is 256 units. Was our first ground-up development that we've done. So, we were strategically sellers for pretty much the last 5 years. Tried to harvest gains wherever we could in our portfolio and really focus on quality, and then wait for the opportune time to get back in and reload the portfolio, which you'll see shortly. We've been doing very consistently this year. I believe we're under contract on our third acquisition of this year, about to go under contract on our fourth acquisition this year. We haven't done 4 acquisitions in a year, probably, I couldn't even tell you, in at least 5 years. We've been really patient, and we're super excited for the opportunities that we're seeing. We think it's a great time to be buying into the market, and we want to consistently continue to acquire, which I'll touch on shortly. But we'll jump into it. So some of the highlights just overall from the URS Capital side. We were able to successfully refinance a project that we did buy in April of 2022, a major value add in Savannah, Georgia, a deal we were trying to buy for years. Acquired it from a long-term 25-year plus owner operator. Rents in place were $988 when we took it over. They are currently $1,519. That's in place occupied rents. We were able to successfully refinance with Fannie Mae. We did not do a cash out, given where rates were. We basically were able to take out our bridge loan, which was a floating rate loan with a rate cap. We were able to take it out inside of 2 years, right at the rate cap expiration, lock in an interest rate of 5.77%, 5-year fixed rate. It was obviously before the rates came down over the last few weeks, but it was a successful refinance. It allowed us to maintain cash reserves of about $750,000 in the deal, and now we'll start generating cash flow distributions on it. It was probably the one deal that we leaned into during the peak run-up, both on the floating rate debt side and pricing. But it's a deal. It's all townhomes. It's workforce housing. We're bullish on Savannah for the long term. As you can see, we've proven our thesis out pretty tremendously with the rent growth that we've achieved, and we're very comfortable owning this asset for the next 5, 7, 10 years and generating consistent tax efficient cash flow for our investors. So it was a big win for us to get to the other side. We've been hearing all the stories about bridge loans. I'm sure you guys are reading, all the updates out there, and maturities and rate caps expiring and capital calls going on, and deals getting handed back and not being able to refinance, major cash-in refinances, needing millions of dollars to refinance. So for us to get this one deal that we actually acquired over the last 2 years to the other side was a big win for us. The project came out fantastic. We executed a $5 million renovation and we're super happy with it. And the deal's consistently running now 95 to 97% occupancy. Another huge win for us was we played a lot of, I feel like, defensive wins the first half of this year. It's kind of the environment that we've all been in our space, right? With a lot of volatility in what's supposed to be a fairly stable asset class overall. But this was a big win for us. It was 200 acres of land that we acquired just under 3 years ago, single family development. We acquired it. It was fully entitled for 391 lots. We took it through the final permitting, all federal, state, and local permitting, wetlands permits, DHEC, you name it, TDEC, city, county, state. It was hours upon hours of work, day after day, week after week for 35 months to get this to a place of shovel ready. Our original intent was to do a JV, bring in a home builder to do a for sale component, and then also do a for rent component. We own the apartments right at the doorstep of this neighborhood. So it was an entire neighborhood, city streets, massive project, 2 sewer treatment systems on site. We decided, given where costs ran up, how much costs have run up since we acquired the land, and also where interest rates were headed, we opted to sell the land. We sold it to a large public home builder. It was a great transaction. They're probably top 5 home builder in the country. They acquired it. They were thrilled because they had a shovel-ready site. They started work literally within weeks of closing. Our land basis fully loaded, all costs was $993. We sold the land for $15.4. So it was a big win on that side. We had the location. We loved the location. We had that right. We knew we had a great site. Just at the end of the day, it made more sense for us to kind of stay in our lane. We're multifamily guys. We're not BFR guys or for sale home builders, that's for sure. So happy to get that one over the finish line as well in the second quarter. And then URS Properties, right? So URS Properties is our sister company that does our property management side of the business. We don't manage third party. It's exclusive for our portfolio, which currently consists of 7 communities, just shy of 2,000 units across 5 states. So I'm going to take you through the performance of the portfolio for the quarter here. Try to get my mug out of the way. There we go. So on the left side here, you've got the property names, you got the unit counts, the market, and then the first bit of metrics that we're going to look at is how the traffic has been, right? So the marketing funnel starts at the top. It's leads, tours, and then ultimately leases. So Belmont Heights was a newly acquired asset in Belmont, North Carolina, so suburban Charlotte. We bought that back in January of this year. This was our first purchase of kind of the reset cycle that we're in right now. Loan assumption, we acquired it with existing debt at 4.6% for 6 more years left on the term. Really kind of undermanaged. The group that was selling it was actually divesting and getting out of multifamily altogether. So it was a good opportunity for us to step in, bring our management style into the deal, and kind of reposition it as a great workforce housing product. It was half townhomes, 1990s, mid-90s construction, all brick, and just a nice, clean, and Belmont, if you've never heard of it, check it out, Belmont, North Carolina. It's a great little town, awesome Main Street, breweries, coffee shops, etc. So, all right, I'm not going to give you the background on every deal that we've done. We'll be here all day. So generated 311 leads, and this is from all sources. That's online, drive-by, phone calls, text, opt-ins, whatever it might be. That led to 134 tours and 30 net leases for the quarter. So occupancy at the close of the quarter was 92%. Occupancy at the close of the previous quarter was 92.6%. So we actually flip it out. The prior quarter average rent was $1,216. We're trending now at $1,257. So in a quarter, we've taken the in-place average rents up about 4%, give or take, which is awesome. So really happy there as we're going through the reposition and retraining of long-term tenants, and dealing with those tenants that don't meet our requirements, to be maintaining north of 90% occupancy in the first 6 months of a reposition and rebranding is always a positive. So really happy that rents are moving in the right direction. Occupancy is holding strong. Crescent Place I touched on earlier. You can see we generated 282 leads, 79 tours, 21 net leases. Occupancy at the close of the quarter, 96%, kind of in line with the prior quarter. Rents are up to $1,519 from $1,500. So now that we're through the reposition, it's going to be very incremental growth. We're not trying to really push too hard. We want to focus on occupancy and collections now at this point. We've, as you saw, we've moved the rents, over $500 in the first 2 years. Latitude at South Portland, 256 units, Class A, mid-rise buildings, 6-story, elevator served, 4 buildings, 75 tours, 33 leases, 98% closed out the quarter. Previous close was 98%. Rents were $22.72. We're now up to $23.24 on our in-place average rents. We underwrote this deal with about $1,900 rents targeting. We have been complete, stabilized now for 2 years, and knock on wood, great resident base up there, great demand for the product, really, really well located asset. The thesis definitely played out well. Exchange at Rock Hill, 229 units. This was ground up development we started in COVID. 233 leads, 67 tours, 40 net leases. When you see the third quarter update, you'll see this is another big win for us. We refinanced this into a Fannie Mae loan that closed in July. So been very busy for us. We actually generated a little bit of a cash out on that one, but we'll touch on that on the next update. So 92.5% occupancy at the prior quarter was 94, so we're down a little bit. Rents are pretty much static here. So this was a bear to get over the finish line, to be completely candid, right? So Rock Hill is suburban Charlotte, about 30 minutes south of Charlotte. Definitely felt the effects of the amount of supply that's going on in and around Charlotte. And we had to really, really fight to get this filled up and maintain, north of 90% occupancy here. And we're not looking to push rents. Our rents are already well above our pro forma because of what happened from 21, 22, and 23. So we're really focused on driving occupancy. We've now executed our refinance, and we'll focus on cash flow distributions. Farmhouse apartments, fantastic quarter for Farmhouse. So we're in lease up on 288 units in Murfreesboro, Tennessee. That's suburban Nashville, 30 minutes south of Nashville. We had 531 leads, 102 tours, and 75 net leases. Really awesome movement here. Quarter over quarter, occupancy is up 10%. Rents are pretty close to flat. We're up a little bit, 1680 versus 1667. Not looking to get super aggressive on the rents. Our focus is to break that 90%. They've been leasing really well through the peak season, that started kind of in March, April. And consistently from there on out, it's been 25 to 30 leases a month. So we're really excited to get that over the finish line. We've got great fixed rate debt on that, actually. It's a fixed rate construction loan at 4%. So we have that through 2026. So we're not really in a rush to refinance that one, given where rates are right now. Cobalt Row, student housing asset, really great deal, not much movement here, 97%. Closeout occupancy at 97%. 159 net leases. That was all pre-leasing for this move-in that happened actually this past weekend. So turn season is basically August 1st to August 15th, and then the move-ins start on the 17th. So we're 99% leased actually for next school year. In-place rent, once rents are booked for the year, they don't move. You'll see we're ended up about 10.5% year over year for our next school year. You'll see that in the third quarter update. So next is number of move-ins, right? So lease tours, leads, tours, leases, and then move-ins, obviously. That's really what moves the needle, no pun intended, on occupancy. Belmont Heights had 32 move-ins, so pretty good consistency there throughout the quarter. So about 10 move-ins a quarter. Average increase on move-ins versus prior rent on that same unit, 10%. They were up on move-ins, obviously, from the prior quarter. It was a half quarter at takeover, and we were just getting our legs underneath us. Crescent Place, 25 move-ins, average increase just shy of 5%, 4.8. So in line with the prior quarter. Now that the deal stabilized, that's kind of where we're at. We'll talk about renewals in a second. Portland, Maine had 31 move-ins, average increase of 8%. Really strong, outpaced move-ins of previous quarter. Exchange was pretty much spot on. No rental increases there, as discussed. Farmhouse Apartments, 67 move-ins for the quarter. The team has done an unbelievable job there. Really, really happy with the team, the progress that they're making, the feedback we're getting from our resident base and our tenant events, and the overall community feedback has been great. So very happy on that. Cobalt Row, 35 move-ins. As discussed earlier, we're going to do about 10% increase on that per bed rent for the 24-25 school year. So renewals, almost all the properties. So Belmont Heights was just shy of 50% on their renewals, but the increases on those renewals, just organic increases, 7.9%. 37 renewals at Crescent Place, 28 move-outs, so they did a great job on their retention, 5.9%. Latitude at South Portland, 47 renewals, which was awesome. Great job, too, on their retention, 6.1% average increase. Exchange at Rock Hill, 19 renewals, 33 move-outs. So the move-outs are tough. That's what's really been the biggest challenge at Rock Hill, is like trying to get over that 95%, but not getting enough velocity through the door on traffic to keep up with the expirations and move-outs. And the move-outs are not from dissatisfied customers by any means. It's probably one of our best received properties from our tenant perspective. It's mainly, home buying and/or relocation that we're seeing there. But average increase on those renewals, about 3%, and same for Cobalt. So bad debt, definitely up in some spots, down in others. So Belmont, this is to be expected. So this first quarter we took over end of January, so we had February and March. And when you take over a property that's been undermanaged, I'm going to leave it kind of at undermanaged, you're going to have to deal with the late payers, the tenants that aren't used to structure and policy and procedures. So we tend to kind of give them the first 45, 90 days to try to adjust to our policies. And then if they're not meeting our policies consistently, we'll start, and we're seeing good traffic now with the rebranding of the property, and we're getting new prospective qualified tenants in the door. We'll start to then wean out of some of the legacy tenants that are not up to our caliber and don't meet our requirements, I should say. So not uncommon to see the bad debt tick up there when you're going through a reposition. Crescent Place, that's pretty consistent for the size of the asset and the profile. So nothing too alarming there. Latitude was down. That's one where there's going to be one or two evictions here and there throughout the course of the year. Exchange at Rock Hill, basically one tenant on that number, so not too material. Farmhouse Apartments was basically two tenants, made up the majority of that balance there. And during a lease up, it's going to happen. You have so many move-ins happening, and you're going to catch one or two, bad actors, as you're going through it. But nothing too alarming, no inherent issue that we're aware of at this point. But this is an important number that we pay really close attention to, right? Because it gives us a sense of, okay, if we're starting to seeing this really tick up now quarter over quarter consistently, is there an underlying issue from a tenant perspective, meaning income perspective, layoffs, things of that nature? Obviously, recession talk is a good hot button, but overall, we're seeing really strong collections. These numbers may look big in a silo, but you have to understand the average monthly income on Crescent Place is well over $200,000 a month. So you're talking about $800,000 of income for the quarter and $6,300 of bad debt. So you have to keep things in perspective. Same for farmhouse apartments. We're about 75% occupied, give or take. So that's, call it 210 units at an average rent of $1,800 a month as the gross. So, we're looking at it more percentage based, and there's nothing alarming across our portfolio that's outside of the norms that we've operated at over the last decade plus. So NOI, obviously, how does all this translate to net operating income, which is how we drive value on our properties? So Belmont Heights, quarter over quarter, NOI is up materially here, $75,000. Crescent Place, great forward movement, 10% increase in quarterly NOI. Latitude at South Portland, 4%. Exchange at Rock Hill, 13%. Farmhouse Apartments, obviously massive because we're going through the lease up. Only one down was the student housing deal, and that's really attributed to basically three kind of one-time expenses. Some IT upgrade work that we had to do for our wireless system. We did Tennessee changed their franchise and excise tax laws, so we engaged our accountants and tax counsel. For a one-time payment, we were actually able to recapture close to $75,000 of past taxes that we had paid, and we have to pay a fee for that. And that was like $18,000 or $19,000 in and of itself. So nothing too major there. We'll probably see that tick back up over the next quarter or two as we get through turn season now for the next school year. So then this side shows us the T12 NOI comparison. So trailing 12 months for Crescent Place versus the prior full year of operations, NOI is up 36%. And that's in 2 years since we took over the deal. And year over year, we're up 36%. So Latitude at South Portland, year over year, we're up 10%. Exchange at Rock Hill was in lease up, so obviously we're up, meaningfully at 192%. And same with Farmhouse Apartments. We're good, but we're not that good. That's because we were starting at zero, so we're working our way up. Sorry about that. And you can see on Cobalt, we're up 6% year over year on net operating income. So all fairly positive through the portfolio. Work orders, I always like to give a shout out to our entire maintenance team, especially our head of maintenance. George is really, a blessing. He is just, an unbelievable leader and, asset to our operations. Traveling, training his guys, jumping in, filling gaps in wherever his need be. But, there's a lot of moving parts day to day. You're talking about on average, for most of the communities here, 300 to 400 work orders. 145 is our lowest at Latitude South Portland to, 480 work orders. That's at Cobalt Row. So it's 244 units, but 750 individual bedrooms, and it's leased by the bed because it's student housing. So in one unit, you can have 4 occupants, that have a different need within their bedroom or bathroom at any given point. So a big testament, and this is really how your renewal rates are better. You strive to be better than 50%. We really strive to be 65% on our retention. It's not just the front office, it's the teams that are servicing our residents, right, and attending to their needs in a clean, professional, and responsive way, on a day-to-day basis. So this is something that I feel like never gets talked about enough on the multifamily side. There's a lot of folks that like to do all the glitz and glamour of, how they've created value and all these other things. But this is really the blocking and tackling that I think, we're seeing in today's environment. You have to earn your upside. There is no more market upside. You have to earn it day in and day out. And it really, at the end of the day, boils down to your teams that you have on your site. And we're extremely grateful for every one of our team members at URS Properties and URS Capital, obviously. So just a quick update, since we were so far lagged on this second quarter update. So occupancy at close of Q2 was 92% in Belmont. We're actually at 95%. The deal's cranking. I was there last week. We're leased to 95% through the end of October. So basically, that's, if nothing else happens between now and the end of October, we're going to maintain 95%. Good chance that's going to end up ticking upwards to 96, 97%, if not higher. Crescent Place holding strong, 94%. Latitude South Portland's up to 99% leased. Exchange at Rock Hill, 93% holding strong. Farmhouse Apartments, again, cranking, from the close of, January, February, March, April, May, June. From July 1 to now, they're up almost, they're up 9 percentage points on occupancy, which is fantastic. Their goal is really to get to 95% by the end of September. Cobalt Row, 99% with all their move-in season. So, there's a quick update. Nothing quick about it, but it's the only way to get through everything. So hope you enjoyed it. Couple of quick things that went on for us on the acquisition side. Really excited. We closed on our 1031 exchange, the purchase of Views at Riverbend, which was formerly Oaks at Broad River, 248 units, Beaufort, South Carolina. 2001 vintage, great floor plans, great aesthetics, great bones, great amenities, great views, but owned by a long-term ownership group for 15 years. Everything on the property is pretty much all original, except for the exterior paint and roofs. So we're able to come in and really kind of transition this property and modernize it. The comp set is all Class A pretty much within, quarter mile to 2 miles of the property. We don't have to look very far. There's a handful of deals that basically make up the market, and this has been the lower end product. So our goal is to come in and modernize and kind of shrink the gap between us and the top of the market. We're long term on this deal. We love it. We think the location's great. We've got great loan assumption at 4% with 6 years left on the term for that, and we have a big renovation planned which is already in full swing. Clubhouse, club rooms, outdoor fire pits, decks, cabanas, grills. Club room, that's awesome. Turf lawn with all kinds of games out there. So really excited to get this one going. We also are under contract to close in October on a portfolio of 3 assets in Asheville. So all workforce housing, not deed restricted workforce housing, but basically as built workforce housing. We're buying from the original developer, operator, manager. They were all built between 1996 and 2009, well below market rents, on these 3 assets, and we think they're going to be great, income producers, super tax efficient cash flow, with fixed rate debt at an average rate of 3.4% with an average term of about 9 years left on that Fannie Mae financing. So we'll go in. We're going to centralize operations a bit, bring in more professional style management, marketing. And leasing, and gradually bring the rents to market. That's it. Just on natural turnover, we'll move the rents up to market, and we'll make some strategic improvements to the property, some amenities, some community spaces, resident event type stuff that we'll do, and really excited to get that one done. Another loan assumption. And then coming soon, we have a deal that we are about to launch, our first real true distressed acquisition, which we're excited for. Those of you that know us for a long time, this is kind of our bread and butter, how we built our business, buying, distressed and well underperforming assets. So really excited for this. 126 units, built in 2007, buying at a 31% discount to the last sale price, less than $170,000 a unit. Great 2-bedroom, 2-bath, floor plans, almost 1,100 square feet. 35% vacant because there's been no management at the property since June. They've ceased operations. So we're doing this as an all-cash purchase. We're going to be raising about $23 million. We need to do it quickly, and we're closing in October, first week of October, actually. So we're going to be off to the races here in the next couple of days. Those of you that are in our database will learn more about this within the next 24 to 48 hours. And those of you that might be interested in learning more about it, please reach out to Rebecca at URS Capital Partners. So yeah, we're going to continue implementing our strategy over the next 12, 24 months. We think there's going to continue to be great opportunities that surface. We really are focused on, motivated, distressed sellers, long-term owners. That's low maturities, assumptions, lease-up challenges, physical issues. There's got to be something to it for us to get excited that we can really sink our teeth into. we're staying somewhat focused in our markets: North Carolina, South Carolina, Tennessee, Savannah. We are starting to look back at our roots, the Cincinnati, Northern Kentucky area. We'd love to continue to look at some opportunities there and get back into that market. And the same goes with Portland, Maine, where we have a presence. We're always keeping our ear close to the ground there. Value add, core plus, lease up, is really our approach. And at the end of the day, we want to just continue to identify unique off-market opportunities to acquire well-positioned assets for the mid to long term. We have basically three core values. After a deal passes our underwriting and we get to a place of offering on it, is the first one is, do we want to be in this market for the next 10 years? Second one is, do we want to own this asset for the next 10 years? And the third one is, are we capitalized appropriately to own this asset for the next 10 years? And if we can't answer all three, yes to all three of those with unconditional commitment, we're not buying the deal. Doesn't mean we want to own every one of those assets for 10 years, but we want to be prepared. I think you're naive to think in today's environment that you can get in and out of a deal in the next 12 to 36 months. It's not going to happen. So we want to buy good assets in good locations that we can be surprised to the upside on. If the market shifts and we're able to sell in year 4 or 5 at the numbers that we thought we were going to get in 7 or 10, that's how we really built our business early on, is going in ultra defensively on the front end, overcapitalizing deals, sacrificing short-term returns on paper to have peace of mind, which allows us to refinance a floating rate bridge loan at par without having to do a capital call. Knock on wood, we're maintaining our streak of never doing a capital call. So we're really excited for what's in store, and we've underwritten 128 deals so far this year to get to the 4 that we're acquiring, and we're going to keep that faucet on. We're grateful for the relationships we built in this business over the last 15 years, and look forward to continuing to expand upon those relationships, both on the deal side and our investor base and our team members that we have here at URS Capital and URS Properties. So appreciate it. Hope you guys enjoyed it. I know it's a long one. Take care.